A financial transformation is on the horizon, and the window to prepare is closing fast. And in just a moment, I'll show you the 5 critical moves you need to make before the clock runs out. The landscape of your personal finances is about to undergo a seismic shift. New legislation, set to take full effect in 2026, brings a mix of new advantages and potential pitfalls for nearly every taxpayer. Whether you're building your career, managing a family budget, or enjoying your retirement years, the actions you take in the coming months will define your financial picture for years to come. We're going to break down exactly what's changing in plain English, and I'll give you a clear, step-by-step plan to not just adapt, but to thrive. Don't let this crucial deadline pass you by. First, you need to reassess your standard deduction if you're a senior. Starting in 2025, taxpayers aged 65 and older will qualify for a significant boost to their standard deduction in extra $6,000. For a single filer, that could mean reducing your taxable income by up to $23,750. For a married couple who are both over 65, that number soars to a combined $46,700. That's real money. For a couple in the 22% tax bracket, we're talking about saving over $2,600 every single year. But here is the critical warning that could save you thousands. This valuable bonus doesn't last forever. It begins to phase out for couples once their modified adjusted gross income crosses $. For single filers, the phase-out starts at $75,000 and ends at $175,000. This means you must be extremely cautious with any financial decision that could spike your income in a single year. A large Roth IRA conversion, for instance, could push you over the limit and cause that entire $6,000 deduction to disappear. This smart strategy. If a Roth conversion makes sense for you, consider spreading it over multiple years to keep your income safely under the threshold, securing your deduction while still protecting your nest egg from future tax hikes. Second, homeowners, especially in states with high taxes, need to pay very close attention. The new law dramatically increases the SAL deduction, capped at your state and local taxes from $10,000 to a much more substantial $40,000 starting in 2025. This is a game changer for residents of New York, New Jersey, and California. This higher limit will even grow by 1% annually until 2029. However, this benefit has its own income guardrails. It starts to phase out once your household income hits $500,000 and is completely gone at $600,000. A one-time event, like a large capital gain or a big retirement account withdrawal, could inadvertently push you out of eligibility. So, timing is absolutely everything. You might want to space out significant income events and explore bunching your deductions. That means grouping 2 years of property tax payments, for example, into a single year to maximize your itemized write-offs. Third, let's talk about charitable giving, because the rules are getting a refresh. Starting in 2026, if you take the standard deduction, you'll now be able to deduct up to $1,000 in charitable cash contributions or $2,000 for married couples filing jointly. This is a welcome new above-the-line deduction. But a crucial detail. This only applies to direct donations to public charities, not to donor-advised funds. Meanwhile, for those who itemize, a new limitation arrives. Your charitable deduction will be capped at the amount that exceeds 0.5% of your adjusted gross income. So, if you are planning a major charitable gift, you might get a much larger tax benefit by making that donation in 2025, before this new limit takes effect. Fourth, you can now get more value from your health savings account. The new law introduces several HSA-friendly provisions starting in 2026. You'll be able to withdraw up to $150 per month, or $300 for couples, tax-free to pay for direct primary care or concierge medical fees. It also clarifies that having a direct primary care arrangement won't disqualify you from contributing to an HSA, as long as you also have a high-deductible health plan. Another major win. Telehealth services are now permanently exempt from your plan's deductible requirements, making access to care easier and more affordable. And the fifth and final step involves your health insurance marketplace, where the rules are getting stricter. The open enrollment period for 2026 will be shorter, running only from November 1st to December 15th. Furthermore, you will now be required to provide proof of your income eligibility for subsidies before you enroll, not after. If your income increases during the year and you fail to update your application, you could face a nasty surprise and have to pay back those subsidies when you file your taxes. This makes it more critical than ever to keep your income records meticulously up to date and to coordinate any financial moves, like realizing capital gains, with your health insurance strategy in mind. So, your pre-2026 action plan is clear. Consult with a financial advisor to see how these new deductions impact your specific situation. Be strategic and deliberate with any Roth conversions. If you're a homeowner in a high-tax state, manage your income to preserve that SALT deduction. Plan your charitable giving with the new timeline in mind, and ensure your health coverage and HSA strategy are aligned with the coming changes. Act now or pay the price later. The most significant benefits will go to those who are proactive. If you found this guide helpful, please do give this video a like and make sure you re-following the Winds of Thought channel for more clear, actionable financial insights. I'll see you in the next video.